The institutions that create currency from nothing somehow need you to have less of it. That contradiction sits at the heart of modern banking, exposing a truth they'd prefer remained obscure. Central banks present themselves as neutral guardians protecting economic stability, speaking endlessly about price management and systemic health. But their actual business model runs on a different principle entirely. When your purchasing power shrinks, specific players capture that value. It doesn't evaporate into thin air. Your financial struggle isn't random economic turbulence. It's engineered profitability, refined across centuries into a precision system. These institutions print money at will, expand balance sheets with keystrokes, and create trillions from authorized decisions. Yet somehow they require your economic compression to function properly. The distance between central bank headquarters and ordinary neighborhoods isn't just geographic. It represents a fundamental financial divide, where your labor converts into their assets through mechanisms most people never examine. They've convinced the world they serve public interest through price stability, economic management, and acting as lender of last resort. The language sounds protective and technical, wrapped in complexity that discourages scrutiny. The reality operates differently. You're not a beneficiary of this system. You're the fuel that makes it run. Every policy decision that squeezes your budget strengthens their institutional position. The fundamental architecture requires your loss to generate their gain. And understanding this inverts everything you've been told about monetary policy. This relationship didn't emerge by accident. It was designed in 1668. Stockholm's merchant district buzzed with competing private banks, where currency flowed freely between institutions. Bankers operated openly, offering loans, accepting deposits, and issuing notes backed by gold reserves they actually held. Competition kept rates reasonable, and practices transparent. Then, Sweden's government made a decisive move that changed everything. One bank received royal charter and became the Riksbank, the official institution. Competitors became illegal overnight. The newly crowned institution enjoyed a profitable revelation. Why limit lending to actual gold holdings, when monopoly status meant no one could challenge their practices? They began printing more notes than reserves justified, creating money with ink and paper. Borrowers received currency that didn't previously exist in any form. When they repaid loans, they returned real value plus interest collected on imaginary principal. The Riksbank collected genuine goods and labor in exchange for fabricated ledger entries. Competitors who might expose this arrangement had already been eliminated by royal decree. This became the template that spread across continents. Privatize money creation, socialize the risk, and eliminate anyone questioning the arrangement. The Swedish model spread across Europe and eventually globally. Today's central banks operate on this 357-year-old trick, though they've refined the execution and buried the mechanism under layers of technical terminology. But the core remains unchanged. Lend money that doesn't exist, collect real interest, and when borrowers default, seize tangible collateral. The Riksbank's merchants didn't understand they were being positioned for systematic extraction. They saw opportunity in cheap credit and borrowed against future earnings they expected to generate. When payment came due, some couldn't deliver. The bank claimed their shops, their inventory, and their property. Imaginary money transforming into actual assets with legal backing. Sweden's first central bank established the playbook every central bank since has followed with remarkable consistency. Your currency operates under these same rules today. That Swedish blueprint evolved into something more sophisticated. The modern version wields interest rates like a precision instrument, creating predictable profit cycles that transfer assets upward with mechanical reliability. Central banks don't just set rates to manage inflation or employment. They engineer boom-bust cycles that allow connected institutions to acquire real wealth at predetermined intervals. The pattern repeats with such consistency, it resembles agricultural scheduling. Between 2003 and 2006, the Federal Reserve dropped interest rates to historic lows, making borrowing irresistible. Families rushed to secure mortgages they could barely afford at those artificially suppressed rates. Asset prices inflated rapidly as cheap money flooded into real estate markets across the country. Everyone felt wealthier on paper, as home values climbed month after month. The expansion phase was designed to create maximum vulnerability and over-leveraging. Then came the harvest. In 2006, the Fed began raising rates systematically, knowing exactly what would follow. Adjustable mortgages reset to unaffordable levels, and borrowers who'd stretched to buy during the boom suddenly faced payments they couldn't meet. Foreclosure signs multiplied across neighborhoods as families lost homes they'd occupied for years. But those properties didn't disappear. They transferred to institutional investors who'd positioned themselves perfectly for the collapse. Bulk purchases at distressed prices converted the crisis into concentrated ownership. The same playbook ran again between 2020 and 2022, compressed into a tighter time frame. Massive stimulus and near-zero rates inflated asset prices across every category from housing to stocks to cryptocurrency. Individuals rushed to invest their stimulus checks and cheap loans into markets already at historic highs. Then the rate hikes arrived with brutal speed. Over-leveraged borrowers collapsed, speculative investments evaporated, and foreclosures began their familiar climb. Once again, those with advanced positioning and capital reserves bought assets from distressed sellers at fractions of peak prices. This isn't accidental economic turbulence requiring reactive policy. It's systematic harvesting, where central banks and connected institutions plant with low rates, inflate with extended stimulus, and reap with calculated contractions. The pendulum swings between extremes with predictable casualties at each reversal. Families sign mortgages during the planting phase, watching values climb. Then the harvest arrives through rate spikes that transform homeowners into former homeowners, while institutional portfolios expand. But interest rate manipulation is just surface-level control. The real mechanism runs deeper, into how they multiply money itself. Central banks set reserve requirements that determine how much actual money banks must hold against deposits. Most people assume that when you deposit $1,000, the bank safeguards that amount in your name. The reality operates completely differently. That deposit becomes raw material for loan multiplication within 48 hours of clearing. Under fractional reserve rules, banks only hold a fraction of deposits, often 0 to 10% depending on jurisdiction and account type. The arithmetic creates money from permission. Your $1,000 deposit allows the bank to create $9,000 in new loans, while maintaining the required 10% reserve. Those borrowers deposit their loan proceeds in other accounts, creating new reserves that support additional lending. The cascade continues. 1,000 becomes 9,000, then 81,000 in subsequent lending cycles. Each layer generates interest obligations flowing back to banks, all originating from your initial deposit that you still believe sits safely in your account. Central banks profit from this arrangement through multiple channels simultaneously. They collect fees on reserves held by commercial banks in their system. Many central banks own equity stakes in the commercial banking system itself, directly profiting from lending operations. Most importantly, they control the leverage ratio, the multiplication factor that determines total profit potential across the entire banking sector. When central banks lower reserve requirements, they expand the money creation capacity of every commercial bank under their authority. Your deposit slip transforms into 10 loan agreements fanning out across the economy. Bank vaults remain mostly empty, because modern money exists as digital ledger entries, not physical currency requiring storage. The pyramid structure means one person's savings supports 10 people's debts, each generating interest income. The numerical progression accelerates exponentially as money multiplies through the system that central banks designed and regulate. That multiplication trick works during normal times. When crisis hits, central banks deploy an even more direct approach. Quantitative easing emerged during the 2008 financial crisis, with reassuring rhetoric about extraordinary measures for extraordinary times. The Federal Reserve and other central banks described it as liquidity provision, a temporary intervention to stabilize collapsing markets. The mechanism revealed something far more direct: large-scale asset purchasing that functioned as a wealth transfer system from currency holders to asset owners. Here's how it operated in practice. Central banks created digital currency through authorized keystrokes, then used those conjured funds to purchase treasury bonds and mortgage-backed securities by the trillions. That newly created money flooded into financial markets, driving up prices across every asset class from stocks to real estate to corporate bonds. Anyone holding investments watched portfolio values soar as central bank purchases pushed prices higher month after month. The outcome split cleanly along wealth lines. The top 10% who own the vast majority of financial assets saw net worth multiply as stock markets recovered and surged past pre-crisis levels. The bottom 90% who hold most wealth as wages and savings experienced something different. Purchasing power erosion as currency supply expanded, while their income remained stagnant. Grocery prices climbed, rent increased, healthcare costs accelerated, but paychecks stayed flat. Central banks now sit on massive portfolios, generating continuous interest payments funded by taxpayers. The Federal Reserve holds over $8 trillion in assets accumulated through QE programs. The Bank of Japan owns more than 50% of all Japanese government bonds. The European Central Bank's balance sheet exceeds 5 trillion euros. Every bond in these portfolios pays interest, real money flowing into central bank accounts from securities purchased with fabricated currency. The stated temporary emergency measure became permanent policy, despite economic recovery. When markets declined in 2018, central banks resumed purchasing. When pandemic hit in 2020, they accelerated again. QE transformed from crisis response to standard operating procedure because it works exactly as designed, transferring wealth from those who hold currency to those who hold assets, with central banks positioned as both facilitator and beneficiary. While headlines debated inflation causes, central banks collected interest payments on trillions they created from nothing. Inflation completes the extraction system through a mechanism so normalized that most people accept it as economic law rather than deliberate policy. Central banks publicly target 2% annual inflation as official policy, a stated goal to reduce your money's value systematically. They frame this as price stability, using language that obscures the actual intention to ensure your currency purchases less each year. The compounding mathematics reveal the true impact. 2% yearly inflation cuts purchasing power in half every 35 years. What $100,000 purchased in 1990 requires over $200,000 to buy today. Your parents' salary that felt comfortable now barely covers basics. This isn't accidental drift. It's announced policy that central banks defend as necessary for economic health. Central banks profit from inflation through multiple mechanisms simultaneously. First, they reduce the real value of debts they hold, paying back obligations with currency worth less than when borrowed. Second, they increase the nominal value of assets they own, with bond and security holdings appreciating in inflated currency terms. Third, they expand the total money supply they control, increasing their institutional scale and influence. Your savings lose value automatically under this system, requiring you to invest in assets central banks have already inflated through their own purchasing programs. The trap closes perfectly. Save and lose to inflation, or invest and buy at manipulated prices after institutional players have already positioned themselves. They've made holding money itself a guaranteed losing strategy, forcing you into markets where they hold systematic advantages. The stated goal of price stability contradicts the actual target of controlled continuous devaluation. Your purchasing power as melting ice cube, shrinking predictably while central bank balance sheets show asset appreciation in nominal terms that disguise real value extraction. Inflation taxes you slowly over decades. When banks face collapse, central banks position themselves to profit immediately through emergency lending programs that guarantee institutional gain regardless of outcome. The lender of last resort designation sounds noble, a safety net protecting the financial system from catastrophic failure. Central banks present themselves as reluctant heroes, stepping in when private markets freeze. The actual mechanism operates more like strategic lending to desperate borrowers, with guaranteed recovery built into every transaction. Here's the setup that makes losing impossible. When banks teeter toward insolvency, central banks extend emergency loans at favorable rates unavailable to any other borrower. The critical detail sits in the collateral requirements. Central banks demand assets worth significantly more than the loan amount: securities, real estate holdings, corporate bonds, and other tangible value. If the borrowing bank survives and repays, the central bank collects interest on money it created specifically for that loan. If the borrowing bank fails, the central bank seizes collateral worth more than the outstanding debt. March 2023 demonstrated this perfectly when Silicon Valley Bank collapsed, along with several other regional institutions. The Federal Reserve immediately activated lending facilities, extending billions to troubled banks at rates below market. Those loans came secured by collateral, government securities, mortgage portfolios, and other assets the failing banks pledged. When some institutions couldn't recover, the Fed took possession of collateral packages exceeding loan values. When others survived, the Fed collected interest on emergency funds. Credit Suisse's absorption by UBS later that year followed similar patterns, with Swiss central bank officials facilitating the transaction while securing their institutional position through strategic lending. The public backstops ultimate losses through inflation and eventual explicit bailouts, but central banks extract value first through the lending process itself. Compare this to standard loan sharking, lending to desperate borrowers while holding collateral that guarantees profit whether they recover or collapse. Central banks operate with legal authority and public relations framing it as systemic protection. The mathematics remain identical. Heads, they collect interest. Tails, they own seized assets worth more than loans extended. Taxpayers underwrite the risk, while central banks capture the upside. Domestic profit mechanisms are only half the picture. Central banks play a global game with your currency that extracts value through deliberate devaluation. Central banks don't just manage domestic policy. They actively manipulate currency values to benefit exporters and inflate away obligations while making your purchasing power collateral damage. They can weaken domestic currency through money printing, making exports cheaper for foreign buyers, while making imports more expensive for you. The split benefits reveal who the system actually serves. Export-dependent industries profit enormously from weakened currency because their products become competitively priced internationally. Governments benefit by reducing the real value of foreign debt obligations denominated in other currencies. But citizens pay through increased costs for imported goods, fuel, food, electronics, clothing, and countless products no longer manufactured domestically. Your grocery bill increases, so exporters gain market share, and central banks' foreign currency holdings appreciate relative to weakened domestic money. Japan's multi-decade yen devaluation demonstrates this strategy in sustained action. The Bank of Japan persistently weakened the yen to support export giants like Toyota and Sony, making Japanese products cheaper globally. Japanese households faced steadily increasing costs for imported necessities, energy, food products, raw materials, while wages stagnated. The policy transferred wealth from consumers to corporations, and from domestic purchasing power to foreign currency reserves held by the central bank itself. Central banks collectively hold over $12 trillion in foreign reserves globally. When they weaken domestic currencies, those foreign holdings gain value in relative terms. The Swiss National Bank famously intervened to prevent franc appreciation, buying foreign currencies with newly printed francs. Those accumulated reserves now generate returns, while Swiss citizens' purchasing power for imported goods decline through the intervention period. The mechanism operates through competitive currency positioning, framed as necessary for economic growth. Currency exchange boards show declining domestic values, while shipping containers leave ports full of exports. Import prices rise at stores, while central bank balance sheets show foreign reserve appreciation. Your wages buy less imported goods, while institutions hold reserves that benefit from your currency's decline. Every single mechanism points to the same conclusion. Central banks operate a coordinated system where your loss generates their gain through mechanisms they've refined across centuries. Interest rate manipulation creates predictable harvest cycles. Fractional reserve multiplication turns your deposits into their profit margins. Quantitative easing transfers purchasing power from currency holders to asset owners. Inflation systematically devalues what you save. Emergency lending guarantees institutional profit regardless of outcome. Currency manipulation benefits foreign reserves while raising your import costs. The pattern isn't hidden. It's obscured by technical language and public service framing that discourages examination. Between 2020 and 2023, central banks orchestrated the largest peacetime money creation in human history, balance sheets expanded by trillions, while official statements discussed economic support and systemic stability. The wealth transfer accelerated because most people don't understand the system's actual function or who benefits from its operation. But there's a reason they prefer financial illiteracy. Knowledge breaks dependency, and understanding central bank profit motives reveals protective strategies that work regardless of their policy decisions. Right now, as you process this information, the cycle continues operating exactly as designed. New rate decisions position the next harvest. Money multiplication generates fresh interest obligations. Asset purchases transfer more wealth upward. Your awareness changes everything because you can position yourself differently. 3 actions counter their systematic extraction. First, recognize the cycle by tracking central bank rate changes and balance sheet movements, so you position before crowds react to policy shifts. Second, hold what they can't inflate away by acquiring assets with limited supply that maintain value when currency supply expands. Third, understand their incentives because central bank actions benefit central banks. Never assume alignment with your financial interests. The Swedish merchants of 1668 didn't understand they were being positioned for extraction. You do. Central bank profit isn't a side effect of monetary policy. It's the entire point of the system's design. The evidence sits in their own published balance sheets showing trillions in accumulated assets purchased with fabricated currency. 17 major central banks following identical playbooks across different continents. 4 centuries of institutional precedent confirming the same wealth flow. Understanding their playbook is your only systematic advantage. I'll keep breaking down the mechanisms they'd prefer remained obscure. Subscribe so you don't miss it.